When people start shopping for homes, one of the first questions that comes up is how much money they need to put down. They hear 20% mentioned often, sometimes from family, sometimes online, sometimes from people who bought years ago. And it leaves a lot of buyers wondering whether that number is a hard requirement, a goal to work towards, or simply a reference point that keeps getting repeated without much explanation. What most people are really asking is, what changes if I put less than that down? Does the loan get harder to approve? Does the rate change? Does the monthly payment change? Does it affect what kind of homes I can make offers on? And does it change how the numbers are put together behind the scenes? So those questions usually come up when buyers are planning carefully and want to understand the structure before committing to everything. In this video, I'm going to walk you through what actually changes on conventional mortgages when your down payment is below 20%. And we'll talk about how the loan is built, how lenders evaluate risk, how the monthly payment is assembled, what underwriting pays closer attention to, and what buyers usually want to think through early. The goal here is clarity, not persuasion, just helping you understand the system so that you can decide what fits your situation. Before we talk about what changes, it helps to slow down for a moment and look at where the 20% idea comes from. For a long time, that number was connected to two things: avoiding mortgage insurance and starting with the larger ownership stake in the home. Because those two outcomes sound appealing, the number became part of everyday home buying conversations. Over time, it turned into something people repeated even when the details underneath were not fully explained. So what's easy to miss is that conventional loan programs allow buyers to purchase with less than 20% down in many situations. The structure simply looks different. So instead of focusing on whether 20% is required, the more useful question becomes, what adjustments appear when the down payment is smaller? Conventional mortgages follow agency guidelines, and those guidelines outline how lenders evaluate applications, how risk is layered into pricing, and what features are added to a loan depending on the profile of the borrower and the transaction. So when you bring less than 20% to the table, the loan still has to pass underwriting. Income still needs to support the payment, debt obligations are still reviewed, credit history is still evaluated, and assets still need to be verified. What changes is how the loan is structured around a higher loan-to-value ratio. That term simply means the percentage of the home's value being financed. A smaller down payment means the lender is financing more of the purchase price. That higher percentage influences things like mortgage insurance, rate adjustments, and documentation review. One of the first structural changes most buyers notice below 20% down is private mortgage insurance. You may hear it shortened sometimes to PMI. This is insurance that protects the lender in the event that the loan ever defaults. So it's not insurance for the homeowner. It exists because the lender is taking on more risk when the loan covers a larger portion of the home's value. PMI is usually paid monthly as part of your housing payment. So in some structures, it can be paid upfront or built into the rate, but monthly PMI is by far the most common arrangement that buyers encounter. The cost depends on several pieces working together: your credit score, your down payment percentage, your loan amount, property type, and occupancy classification. Because those inputs vary from one buyer to another, PMI amounts can look very different even on homes with similar prices. That's why early estimates are helpful. They let you see how this part of the structure affects the total payment rather than guessing. When people think about affordability, they often start with principal and interest. That is the base mortgage payment tied to the loan balance and the interest rate. What sometimes gets overlooked early is that PMI sits alongside other components. So your full monthly housing payment usually includes principal and interest, property taxes, homeowners insurance, mortgage insurance when required, and HOA or condo dues when applicable. Those pieces stack together. If one of them is missing from early estimates, the final number can feel higher than expected once underwriting is complete. So including mortgage insurance in planning conversations early makes budgeting more predictable. It also helps buyers decide whether the structure still feels comfortable or whether adjustments might be helpful. Another question that comes up quickly is whether interest rates change when the down payment is smaller. So on conventional loans, pricing is influenced by risk characteristics. So loan-to-value ratios is one of those characteristics. Higher loan-to-values can bring pricing adjustments within the rate structure. That does not mean one single factor determines the outcome. Rates are assembled from multiple inputs, including credit profiles, down payment levels, property types, occupancy, loan size, and the market conditions at the time of the lock. So what matters for the buyer is understanding that rate quotes are built from several pieces working together. A smaller down payment can be one of those pieces. It sometimes helps to think about this in simple terms. Imagine two buyers purchasing the same home at the same price. One brings 20% down, the other brings 5% down. The second buyer is borrowing more money. That alone raises the principal and interest portion of the payment. So mortgage insurance may be added at that time. There could also be a modest pricing adjustment in the rate. So each element might seem manageable on its own, but when layered together, they create a noticeably different monthly figure. The same kind of change happens often when loan terms differ. So shorter terms usually increase the monthly payment, but reduce the total interest over the life of the loan. Longer terms often lower the payment while increasing the total interest paid over the life of the loan. So those shifts come from math and structure, not sales tactics. Buyers often wonder whether putting less down makes approvals harder. Underwriting still looks at the entire file. So income stability, employment history, debt ratios, credit patterns, reserves, property eligibility, all of those things matter. When the down payment is smaller, underwriters may review the overall risk picture more closely. And that can include detailed asset verification, reserve requirements, appraisal reviews, credit history depth, and payment shock analysis. It does not automatically prevent approval. It simply means the rest of the file needs to support the structure being requested. That's one reason early conversations are helpful. They allow time to shape the strongest version of the application rather than adjusting later under contract deadlines. Because down payment size affects the monthly payment, and it can influence how buyers approach shopping. So some buyers adjust price ranges, others widen or narrow the geographic areas, some change the type of property that they focus on. Condo dues, tax levels, and insurance costs can matter more when margins are tight. So those adjustments are all about aligning the purchase with your long-term comfort. So a home that fits today and still feels manageable later tends to create a calmer ownership experience. When buyers are exploring options below 20% down, these are the kind of planning questions that often bring clarity. How much cash do I want left over after closing? What payment range feels sustainable from month to month? How long do I expect to own this home? How comfortable am I carrying PMI for a period of time? Do I expect income changes in the near future? Would waiting to save more meaningfully change the structure? So those conversations are easiest when they happen before offers are written. That timing gives you room to evaluate scenarios calmly. Mortgage insurance on conventional loans is often temporary. Once certain equity thresholds are reached and the loan meets program requirements, PMI can usually be removed. And that might happen through scheduled principal reductions, home value appreciation, a new appraisal when allowed by the guidelines. So understanding that process helps buyers frame PMI as part of the early years rather than the entire life of the loan. So it becomes one component of a broader ownership plan. As buyers learn about lower down payment options, a few assumptions often surface. These usually deserve clarification early. So believing 20% is required for every conventional purchase is a big one. Assuming PMI lasts forever is also another one. Expecting the rate to be identical at all down payment levels is not the case. Looking only at principal and interest instead of the full housing payment is a big mistake. And then waiting until after contract acceptance to explore detailed scenarios, it's too late at that point. So clearing up those early tends to make the process way smoother. Putting less than 20% down on a conventional mortgage can work well for many buyers. What changes is the structure. So mortgage insurance is commonly added, rates can be influenced, payments include more layers, underwriting may review the overall profile more carefully, and those adjustments exist to manage risk within the lending system. So for buyers, understanding them ahead of time creates options. It allows decisions to come from planning rather than reaction. If you're thinking about buying with less than 20% down and want to understand how that affects your financing options, use the link below to book a call with my team. These conversations are most helpful early before an offer is written because they can save time, stress, and surprises later. And if you want clear explanations about how lending rules actually work in today's market, make sure to hit that subscribe button. My goal is to help you make informed decisions with confidence and ultimately win with Wade. We'll see you in the next video.